Hello everyone, my name is David Angel and today I'll be presenting my financial evaluation of Abitasol's proposed Hola Kola project, a low-calorie soda designed to capture the rapidly growing health-conscious market. Now, our objective here is simple. We just want to determine whether this investment creates or destroys value for our company Babitasol. We'll look at the project assumptions, relevant cash flows, valuation metrics, sensitivity to some market changes, and finally, decide whether or not the company should move forward. Now, let's begin with a quick look at what Hola Kola actually is. Hola Kola is Babitasol's response to shifting consumer preferences, which is people wanting more beverages that are low in calories but high in flavor. The company plans to launch it as a budget-priced, low-calorie soda produced in the existing plant with some use of an unoccupied annex. The project's life is projected around 5 years with an upfront investment of 50 million pesos. Now, if successful, Hola Kola could expand this firm's product portfolio and help protect market share against healthier competitors. Here I have included Babitasol's sales and return on sales from the years 2009 to 2011. As we can see, sales start off from around $642,400 and an ROS of 4.21% and nearly increasing almost $300,000 in 2 years and an ROS increase from 4.21 to 5.57 in 2011, but we can see sales and ROS begin to plateau. Now, before diving into some more numbers, let's outline the key assumptions that drive this analysis. This case uses several key financial and operational assumptions. To begin, the cost of capital, or otherwise known as the discount rate, is 18.2%. Next, we have a corporate tax rate of 30%. Monthly sales of 600,000 pesos, and lastly, a potential erosion of existing soda sales estimated at around 800,000 pesos. These frame our base case analysis. Next, we're going to identify which cash flows are relevant and how to handle special cases like the annex and our market study. In capital budgeting, we focus on incremental cash flows. This is the additional inflows and outflows directly caused by the project. Here's how we treat some specific items in the case. The market study, which has already been conducted, is a sunk cost and should not be included. The annex, which has potential income, otherwise known as an opportunity cost, must be included. Interest charges are ignored in cash flows because they are already affected in our discount rate, so we would not want to double count the interest rate. And our working capital is included because it ties up cash during operations but is recovered at the end. Finally, we want to consider erosion in the existing soda sales, since Hola Kola could cannibalize some regular soda demand. This is important because erosion reduces the project's incremental benefit and must be subtracted from new revenues. With these flows defined, let's review what the valuation numbers actually tell us. Under our base case, we have a net present value, or NPV, at around negative 1.72 million pesos, an internal rate of return, an IRR, of 16.86%, and a payback period of 3.41 years. Now, if NPV is positive, which in this case it is not, that would add value to Babitasol. But in our case, NPV is negative, and the IRR also falls below the discount rate. This would destroy shareholder value, and the project would deem unprofitable. Now, assumptions can change, so let's test the project's sensitivity to some key variables. In scenario 1, starting in year 2, energy, labor, and material costs rise 5% annually, while sales price and volume stay constant. This changes our NPV to around negative 4.7 million pesos, almost 3 times less than our normal NPV, and our IRR shifts to 14.4%. That is about a negative 2% decrease. Now, in scenario 2, we have the same cost increase, but Babitasol can raise the sales price by 5%, but also lose 2% of sales volume. Now, our new NPV becomes 96,107 pesos, an IRR of around 18.27%. Now, that passes out some cost to the consumers, which significantly improves our result and nearly restores our break-even value. Now, let's interpret what these outcomes mean in some practical terms. So, from our comparisons, we see that Hola Cola's success is highly sensitive to both cost management and pricing power. A modest ability to raise prices offsets much of the inflation risk, but any sustained increase in costs without pricing flexibility quickly pushes returns below our thresholds. Now, this is important because strategic planning and controlling input costs and maintaining brand value is strong enough to support small price hikes. Now, beyond the numbers, let's weigh the broader benefits and risks of launching Hola Cola. So, as we can see, some benefits expand the company into a health-conscious market segment. We utilize existing production facilities and infrastructures, and we want to strengthen our brand perception by aligning with healthy trends. Now let's look at some risks. We risk erosion of existing soda sales. Rising input costs threaten our profits. The market may reject a low-priced diet product, and we use working capital for a new investment rather than reinvesting into our existing soda sales. So overall, the project offers a strategic diversification, but carries notable operational and financial risks. So, based on these trade-offs, let's move towards our final verdict. The recommendation is to reject the project under our current base case assumptions, but we can reconsider if management can secure cost efficiencies or verify a stronger market demand. But given the financial outcomes, Bebida Sol should proceed cautiously if they would like to roll out the new Hola Cola product. However, if costs rise faster than revenues, or if erosion of regular soda sales is higher than expected, then this project becomes highly unprofitable. So, let's finalize some of our key takeaways. Hola Cola aligns strategically with changing consumer preferences and can strengthen Bebida Sol's long-term brand presence. Yet, financially, the project's current conditions fall short of required returns and results remain sensitive to cost and price assumptions. Thank you.